Hello everybody, and a very warm welcome to another one of our Back to Basics videos here on the Working Trader. So today we're going to look at the spread, and I think the spread is something that a lot of people know about, but it's often considered as a kind of afterthought when you're trading, and actually I think it's really important when you're looking at your risk or when you're looking at whether you should take certain trades. So just really basic, what is the spread? It's the difference between the price you pay for something and the price you get for selling it at any given time. So as you can see on the chart here, the price you pay is 26.66 and the price you pay for, so that's the price you pay for buying, and the price you pay for selling is 26.38. Now, I can't remember if this is in dollars or pounds, I'm not sure what chart exactly this is, but essentially, if you were to open the trade and go long at that moment, for example, or short actually, but as soon as you open the trade, you'd instantly be down. So you would instantly be down in this case, 28p. Yeah, 28p. Just for opening the trade. So if it doesn't move anywhere, if it stays exactly the same, you haven't broken even. You need it to move if you went long up 28p, and that's just to break even. So as you can see, that's quite important to look at when you're trading. So as I said, the spread, difference between the buy and the sell price, and this is how the broker or your platform provider will make most of their money. And the spreads differ between brokers and they differ between instruments on a broker. But if you can imagine, it seems like a tiny amount, 28p. But you know, if they've got hundreds or thousands of people trading every day various different instruments, it adds up. And I think a lot of brokers nowadays are commission free. So as you can see, that's how they have to make their money, or that's one of the ways that they make a lot of their money. So we're going to look at some spread examples here to show you the difference between a tight spread and a wide spread. So on the charts here, we've got on the top the Euro US dollar on the daily chart, and at the bottom we've got Great British Pound and the Romanian low or lei. I'm not exactly sure how you pronounce it. Again, on the daily chart. Now, the Euro US dollar is one of the most traded instruments in the world. It's extremely liquid. So that means there are a lot of buyers and sellers at any given time. And because of this, the platforms, the brokers are getting loads and loads and loads of trades. So the spread they can charge, they can still make a lot of money just from having a tiny small spread. So as you can see on the chart here, we've got the buy and the sell price, the buy in green and the sell in red, but they're actually so close together on the daily chart that you can't actually see it. The red is behind the green. So the amount the currency pair would have to move for you to break even, if it went in the direction you wanted it to go, is really small. But now if we take a look at the pound low, lei chart, it's not very liquid. It's got much smaller trading volume, much fewer buyers and sellers. And as such, for the broker to be able to make this worthwhile for them, they have to widen the spread, because if they've got fewer people buying and selling, um, they need the amount that they take, the difference between the buy and the sell, to be bigger for them to make money off of it, really. Um, and so why is this important? Well, if you look on the chart here again, this is a daily chart. The distance between the buy and the sell price, so the spread, is actually wider than most of the daily movements. So what that means is, even if your thesis is right, and even if the currency pair moves in the direction you thought it was going to move, you might not even break even for a day. And that's obviously an important thing to note when you're looking at your risk, where you should put your stop losses, and whether it's even worth putting on a trade. Because if a trade is just bouncing up and down in a range, uh, as you've got here, or sort of as you've got here, imagine if the spread, instead of being that wide, was actually sort of from there to there, really wide spread. It wouldn't be worth taking the trade unless you really had some other thesis of why you thought the trade was going to go sort of very quickly and very heavily in one direction. So just something to note, something important. Generally, when you open up a broker, the default setting, it will just have a price there. Um, it's normally the buy price, I think. But I always change my settings, so I've got the buy and the sell price on there, so it kind of gives you that instant visual, um, which can show you whether you think it's going to be worth taking a trade. So that's normally in your settings on your platform or with your broker. So I hope that was useful. Let us know what you think about spreads in the comments below, and of course, like and subscribe and share if you enjoy our videos. And have a very nice day. Take care. Bye now.